Okay, so let's take a look at the trade alert today. Then we'll jump into the news. Of course, Trump's calling it the best trade deal of all time. Bottom line is not really much was accomplished there. Kind of like the war in Iraq, we spent a ton of money and what did we get out of it? It was a joke. And then I'll do a quick review of how the strategy works, why it works, and then we'll pass this back to Dean. Okay, so the top of your trade alert is always going to have the current trade. And I wanted to be a little more bullish on today's trade, but the outcome was so shady this morning of the trade deal that we're playing it safe. So we are selling the 318 call and purchasing the 316 put. This allows us to generate a potential profit of $1 per share of the SPY that we own. Now, once again, you have to own the asset to follow this strategy. This is a strategy that takes advantage of having ample capital to be able to sell call options and then use that to finance either downside protection or just to simply make a profit. So the current trade is to sell the 318 call expiring Monday and to buy the 316 put. And so all that really means is we will stop earning profit at 318 on the long side. Now that does not mean you'll lose any money if we go above 318. It simply means we stop benefiting from the SPY ETF traveling higher after we go over 318. Now on the other side of the trade, we have a 316 put. So we're long the put option. This means we're able to sell our shares for 316 no matter how low the SPY goes. So for whatever reason that could happen between now and our next trading period, which is noon Monday, you cannot lose more than $1.02 or about $1 per share on the SPY. So that's our trade setup today. And again, we're short the 318 call, which means we're taking in a credit. We're essentially agreeing to sell our shares of the SPY for 318 per share to the option buyer. And we are the underwriter or the option seller. Now to take that deal, the option buyer paid us 51 cents approximately. Now let me pull up the current prices so we can see if it's changed much, but not much. So it's been going up in our favor already. So we're already in the money on this trade if you were able to get a similar price to me. But the risk to reward ratio is very similar if you're just entering now. So I wouldn't alter the trade at this point if you're seeing the prices right now. Okay, now on the other side, so a lot of people get concerned about selling options. They think that's a very risky thing and they don't always understand what it means. So let's just walk through what could potentially happen to be assigned. That's the scary word for a lot of investors. What happens about assignment? Well, in this case, the option call purchaser is probably most likely a younger investor who wants to double or triple their capital. They're gambling that we're going to be in a melt up mode because the trade deal was signed, and also because there's massive financing hitting the banks through the Federal Reserve. So it's probably not a bad bet on his end, but from our end, it's not going to hurt us if he's right. So right now, when we entered the trade, the SPY was at 316.64, and we're agreeing to sell our shares for 318. So just built into the contract is an immediate profit of $1.36. Now, if we are assigned and the option buyer does exercise his right, then we get to keep the 51 cents as well. Now, what's going to happen to the value of a long put option if the SPY travels higher? Well, this put option is going to lose value. So this trade setup provides a heck of a lot of protection to prevent loss. But if we have predicted that the SPY ETF will travel higher, these options are going to show a loss and the profit will be generated from the underlying asset. So this is a relatively tight but bullish option caller trade. So that's the setup we have right now. Now, what would happen on the other hand if the SPY were to just tank? Who knows what reason? Maybe people are just taking some profits going into the end of 2019. Maybe China says they don't plan to buy any agricultural products. There's a whole host of things that could go wrong. What's going to happen? Well, we sold the 318 call and collected 51 cents. The call option will quickly lose value if the SPY travels lower. So if we're actually wrong on this trade, you're going to see your options show a profit. And I've found that's a common misconception with people following our program, is that sometimes they think the options are always how we're trying to derive the income or the profit in that trading period. So in this specific setup, look for the SPY to travel to 318 or higher to achieve the maximum return. And on the other hand, if it travels lower, you should expect your 318 call option you've sold to show a very high profit. Usually we can see around a 98% profit depending on how low the SPY has traveled. And also expect to see that 316 put go up in value. Now, we're not going to be able to completely mitigate all losses to the downside with this trade. But once again, our maximum risk is $1.02. So we could go to 310, 300, 290 on the SPY Monday. It wouldn't matter. We're still going to walk away with a maximum loss of $1. So let's just take a quick break and make sure this piece of the trade does make sense to everyone. Are there any questions out there about how this works?
I'm just learning as you go along.
Is that the doctor from Maryland?
Yeah.
Excellent. Okay, great. So have you ever done any option trading?
No, I'm still reading a book on it.
Okay, great. So I would argue that we take advantage of two parts of the option market. Number one is that betting up by purchasing call option in the end is a bad bet. It's a risky bet that loses time premium, and more than not, the market just kind of travels flat. So we love to sell out of the money call options for income and to finance downside protection. On the other side of the coin, buying put options is a lot like purchasing health insurance. It's a great deal, especially when a disaster occurs. And so that's just the two sides of the option market I'm willing to expose our portfolio to. Now, if you've followed other programs in the past, you can take this concept and go array. So for example, a popular strategy is to scan stocks to see where the highest yield is on the covered call. And you better bet your bridges that any stock that has a huge yield from selling a covered call, the underlying asset is extremely risky. And that's why it offers such a tease to bite on the bait. Okay, now the SPY ETF is 504 companies. So you're removing the business risk. And at this point, your only concern is systemic risk. So we're not going to get hurt by a bad earning from one company, a bad lawsuit, some antitrust lawsuit, or maybe even a hedge fund that's just targeting a specific company. So, I've had people ask me, well, what if we put this strategy on Tesla? Oh gosh, no, definitely not. What about NVIDIA? Oh no, that's how you end up with massive losses very quickly. Now, another popular strategy is to sit there and sell put options. And so that's the exact opposite of our strategy. If we are assigned in our short option, we end up in cash the next day. And we've achieved in most of our cases, the maximum profit. So this makes for a very passive, hands-free trading strategy and allows our trade alerts to be what I call atomic bomb proof. This means under no circumstances will there ever be any reason to touch the portfolio outside of our trading period. Now, in 10 years of being in this business, I can tell you most traders that I've managed and represented, you tell them they can only trade a specific stock on a set schedule at a set time, and they feel like that their hands have been handcuffed. They hate it. But yet, they're out bragging about all these returns they've made. Well, we'd send the marketing team to go call and collect testimonials. Guess what? No one else got the result. So in our program, and we've got a lot of members on here, they can testify right now that they get the same result as I do, whether it's good or bad. And so the reason this is possible is because we have a very strict trading plan, a very strict trading strategy, and it's very easy to follow because you know exactly when we're going to manage our positions, which is Monday through Friday at noon Eastern. Also, this trade takes you less than a couple minutes to put on and does allow you to do it from your phone. So we've literally got millionaires putting these trades on from their phone, from restaurants, from airports, and even from road trips, as long as they have service. Now, I do see a few questions, one from a guest with their hand raised and one from Don Nelson. Please feel free to ask your question now.
Jason, this is Jeff.
Hey, Jeff.
Just a question about dividends. So SPY does a dividend. I think it goes ex-dividend next Friday. How does that work with how you trade? Do we completely get out, or just explain how that works with the dividend next Friday?
Yeah, we're going to try to pick up that dividend as best as we can. The only risk of not having the dividend is by being assigned on the date that you had to own it before the dividend is provided. So yeah, we will try to collect that dividend on all 4 of our assets that do provide dividends.
Thank you.
And
sure, there can be a little, the dividend can reflect on the price a little bit, but it's not a big deal.
Thank
In
you.
fact, our returns, I'm going to add in the dividends of the year probably this weekend, and that will boost us up considerably because, if you're the kind of guy who likes to collect dividends, well, the SPY is collecting dividends from 504 companies. Now, Don Nelson, do you have a question?
yeah, Jason, like the last one where we had the call short at the 316, could they have called us away because it's above that before we got into this other trade if we wouldn't have bought it back?
Yeah, if we're ever assigned, because the call option has exercised his right to utilize the option contract, then we just buy back the next day, the next trading day. Wait until the trade alert's out so you can immediately apply the protection of the option caller.
Right, but today they could have done that if they wanted to, right? If somebody would want to get that 316 call from us, they would have called us away then, right?
Not necessarily. So the way option assignment works is all of the call option buyers who have, let's say yesterday, a handful of call option buyers decided to sell their call option. That all gets routed to the option market. And then the next day, overnight, they use a lottery system to reward the sellers so that they can collect the agreement. So it's actually a great news. If you get assigned, you should feel like you're lucky in that case.
But they could have done that if we wouldn't have bought that. They could have done that with ours, because we were below that or above that 316. They could have done it if they wanted to.
They could take a loss too. Yeah, you can get assigned at any time. Yes, what will happen is you'll wake up with your maximum profit and you'll be in cash.
Okay, so then the next day, the Monday, you would have to buy the shares back.
Yeah, and I'd wait to buy the shares until the trade alert comes out so you can immediately protect it rather than just have a naked SPY position.
Well, that wouldn't happen until after the close of the day on Friday, would it?
If we were assigned today, which is highly unlikely.
Well, I'm already out of it. I've paid it and went to the next one. I went to the December 19th one. No.
Yeah, so if you were assigned tonight, you would find out Monday morning, and essentially you'd be in cash, and we're paid $3.18 per share plus 51 cents per share.
No, I'm talking that 316 one, the one that we just paid to get out of.
Right.
The last order was a
Sign the
316.
same
So,
day. Yeah, you can't get assigned the same day.
so you wouldn't know until after the close at 3 o'clock. But we're
No,
always
'cause
buying
we
out of it,
closed
so
out,
we're
so
into the
you're done.
right.
You're
But I
out of
mean,
that.
we're always taking that loss on that call, but then we're making it back on the underlying. Correct?
I'm sorry, what's your question?
Well, we're selling that call, and that call is in the money when we're selling it, so we're going to lose on that end of it, but we're going to make it up on a little bit on the underlying, I suppose, because you're not going to make anything on the put.
So you're referring to our trade from Wednesday?
Correct. That was a 316 call we sold.
Yeah, let's look at the math. So that's the next part of our trade alert each day is I audit the return so you can see how we put the trade on. So we sold the 316 call on Wednesday and purchased the 312 put. And this is when the SPY was trading at 313.94. So if you do want to audit your returns following our program, here's all you need to know. Number one, what was the value of the SPY when I applied the option collar? So in this case, it was trading at 313.94. Next, when I rolled over the position, which is what we just did, what was the value of the SPY? So in this case, it was 316.63. Now I'm doing the trade about 20 minutes before you guys get the trade. And this takes an entire team of people for us to be able to build this document, get it into HTML and deliver it to you. So there's about a 20-minute lag, but you're going to see the amount of accounting I'm doing each day. So you know exactly what's going on with all 4 positions is remarkable. It's nothing like anything I've seen in 10 years of being in this business. So let's just look at the accounting. So the SPY went up considerably by about $2.69. The collar, the option collar, going back to, and you can always go verify this for yourself. This is another thing that most advisors don't do is provide complete transparency on every single trade. You know, there's a lot of crooks out there, certainly. So let's just scroll down and look at the previous trade. So we can see right here. In fact, it looks like it was trading at 313.94. So my apologies on that. The debit was 23 cents. You can see we sold the 316 call and purchased the 312 put. So then we go to today's trade alert. Oh yeah, we have it correct. Okay, so you can see the SPY went from 313.94 to 316.63. The initial collar went from a cost of 23 cents, so a debit, and then to close out the option collar, we had to pay an additional 91 cents. So we predicted the upward move correct. And just like in this trade setup, the options lost money, but the underlying asset delivered the profit. So we walked away with $1.55 profit per share. And what's important about this is we did it with extremely low risk. If we were wrong, we're not going to get hammered with a $3, $4, $5 loss per share on the SPY. And that is easily what could have happened if this trade deal didn't at least create what I'm calling the phase 1 deal more of a ceasefire. There wasn't really any deal made. We delayed tariffs, and now we're going into phase 2, but we never even completed phase 1. We'll look at the news in a minute. So that's how simple it is to audit your return. And let's stop right now. And now, does that make sense, Don?
Thank you, Jason. That made a lot of sense. Appreciate it.
Okay, great. So we lost on the options, but that was the plan. So if we do a bullish option collar, your options lose money, the underlying delivers your profit. And when I do go to the overview, I'll show you our 3 trade setups. And it's very simple. We have bullish, neutral, and bearish option collar. On the bearish or neutral trades, your underlying won't deliver the profit. In fact, the underlying may go down in value and your options both deliver profits. So in a neutral trade, it's really the call option sold at the money that's losing its time premium value that delivers our profit. In a bearish setup, you're going to derive your profit from an in the money put. So I'll show you guys the three setups. It's very simple. And more importantly, it's very passive. And it's what I call atomic bomb proof. All four positions are always atomic bomb proof. Okay, let's continue. Okay, now next we have a whole sling of trades if you want to go review some previous trade alerts, but also I do want to point out our website does post the trades after the close each day so that it's open to the public to audit and review. So you have your three categories: Monday, Wednesday, Friday. You have your Tuesday trade and your Thursday trades. So it's organized into those categories. Now that's public. The boot camp content is not public. So that is private content. Okay, scrolling down. Next thing we have is a reminder of the trade schedule, as if you haven't heard this enough. But we have lock this in. This will not change whatsoever for at least 2 years. And when we do the big picture overview, we'll talk about when we might consider changing these. But it's important to note that we can generate a profit in any direction on any asset by designing the option caller. And it's not complex. This is very simple. Once again, we have a bullish option caller, a neutral option caller, and a bearish option caller. And so for bullish, once again, underlying asset delivers your profit. The options will lose value if we're correct. If we're wrong, the options go up in value and protect the underlying asset. So the SPY is traded Monday, Wednesday, Friday at noon Eastern, taking advantage of 3 option expirations per week and putting the bulk of your portfolio, 40% in the SPY, into the most highly traded ETF in the world. There's nothing that comes close. It now has 260. Well, now it's probably closer to $300 billion in assets under management. It's it's the most popular ETF, and it's single-handedly been collapsing hedge funds left and right because they just can't outperform the SPY. So if you own any specific stocks, I'd highly recommend playing it safer, removing business risk, and go to the SPY. Emerging markets is our Tuesday play. Now, this gives you access to 1,000 companies in a single ETF. It's the single most traded non-US ETF by far. And it is pretty much Asia x Japan. So you get China, India, South Korea, Russia, and then a whole bunch of smaller companies that they do business with. Now, once again, we can play that in both directions. The TLT is the long end of the treasury. So that's your 20-year and 30-year bonds.
We're talking about
have your T-bills or your notes. So we're playing the long end of the treasury market, which is the most sensitive to interest rate changes. And there's a very simple correlation. When the SPY goes down, usually the TLT goes up. So by simply having a 2-to-1 ratio of the SPY to the TLT makes it very hard to lose money. Now, in some rare cases, like we have in 2019, they will actually travel up together even on the same day, which is usually unheard of. We'll take a look at why that's the case. It has to do with the repo making treasuries extremely attractive at this point in time. GDX is the gold miner ETF. Gold is extremely volatile, which means you can derive very nice profits from that. And it's somewhat correlated to bonds. So that's why we trade those together on Thursday. So we essentially have 40% of our assets in the SPY, 40% in the TLT. Then we have 10% in emerging markets and another 10% in GDX. Now, it's not exact, but that's just rounding to the nearest 10. And to make your life simple, for every 100 shares of the SPY you own, you're going to want 200 shares of the other assets. Now, this is a really important note, especially for someone like James, who's considering following the program. You wouldn't just go buy all of these assets at the same time. What really makes the most sense is to probably start with either the Wednesday trade or the Thursday trade, so that you can build your core positions in a period of 2 days. So that would mean purchasing 100 shares of SPY on perhaps a Wednesday, and then 200 shares of the TLT on Thursday. Now, if you wanted to just leg in with a $75,000 portfolio and you really have more like $1 million portfolio, okay, well then it's not going to be the end of the world to start, say, today, and then go through the flow for a few weeks and gradually build up your position. And in fact, that's what most of our members do. I've seen most of my clients will come in and slowly build the trading plan in one set, see it works. They'll probably have some losses in whatever they're doing on the other portfolio strategies. And sure enough, within a few months, most of our clients will be completely invested in this strategy. They might have a little bit of money that they put on the side for funny money for playing more risky strategies. But it just takes getting burnt a couple times, and our clientele just realizes it's not worth it. Okay, so that's the trading plan. Let's take a quick break and see if everybody follows that so far. James, any questions so far?
Not yet. Just listening and trying to figure out what I can do. I'll end up paper trading first, I'm sure.
Sure. Now, do you feel like you could sneak away at noon to do a trade each day for 2 minutes?
I'll have to wait and see what my next situation is. I do contracts.
Okay. Yeah, that's the one thing. Now, I would say the trades are typically good till the close of the day. So we do have people that aren't right on the exact second as we are. Okay, let's move down. Next part of the trade alert is a audit of our open positions.
I have a question.
Oh, go ahead.
On your, where you did the audit on the SPY, that depends, that number that you have there depends on when you bought your 100 shares.
No. So we're going to audit from each trading period. So we're going to audit the second we put the trade on until we close it. So we're only measuring the profit from 12:11 when I entered the trade, and then 12:13 when I exited the trade. And that way we can track our progress. Because if you bought, a lot of my clients have been following me for almost a year now. So they're up tremendously on the SPY, obviously. And that wouldn't give them a clear indication of whether they made a profit or not during the previous trading period. And so because we're rolling over the position, we're not just holding the SPY naked. You can see our audit for every trading period. So there's always an option caller immediately applied. So we're just rolling from one option caller to the next. And the audit that you want to do on your end is to look at the price of the SPY, exiting the option caller, and then entering it. So it's in one time frame that you're doing that. Now, sometimes you'll see that maybe, let's see if there's a change in price just in today's example. So when I exited the position, I was at 113.63. And by the time I was able to put on the new position, it had changed a few cents in my favor while I was naked the SPY. So I guess there's an extra 4 cents that's not included in this audit. Now that is included in our spreadsheet. Now that is another feature that you guys get is a copy of our spreadsheet so that you can learn how to fill it out and have the same accounting that I have. And again, that's something we'll be spending about, what was it? I think we dedicate 4 weeks to that in our boot camp program. So all these screenshots are from my track record, which you can always access as well in every update. So I'll just give you guys a quick look at that. I think one thing that really sets us out from the crowd is, besides being safe, easy to follow, passive, and actually, people get the same result, is by far superior accounting. I've not seen anything anywhere near this level. So on the summary tab, I have the total return. We're almost at, I think we just hit 13 months officially. You got your total return of all strategies combined.
There's a couple cops there. They're gonna get you.
And then we have a breakdown of each strategy individually, month by month. And then below that, you have your balance start and end of each month per strategy and total portfolio, which is obviously how we get the monthly return. And then you have a tab for each of our different strategies. So you have a trade history right here. You have everything. So everything that I've screenshotted is from the spreadsheet. And this is also another bonus that everyone who joins our program gets. Now, not everybody wants to fill out a spreadsheet, say maybe 2 out of 10, but surely a lot do. And it's definitely a nice way to keep track of what you're doing. And something we do train in the boot camp. I have some, a couple hours of content you can watch to do it yourself. But if you do want really hands-on education on how to manage your spreadsheet, then that is about 4 weeks in our boot camp program. Does that answer your question?
All right, I'll call her later today. Okay. Oh, I'm doing good. I'm doing good.
And we got a few other guests joining in. Welcome. I've unmuted your mic if you do want to chat.
No, I mean, there was snow on the road and everything, but there was no snow coming down. We got to Carson City and
Somebody talking about snow. I'll try to.
Tons of snow, but we were fine. We didn't.
Oh, there it is. Okay, I muted that one. Okay, let's take a look at the next set of trades we have open. So on Tuesday, we played it safe. We've been playing it safe on emerging markets for 2 weeks now. And so we did the bearish trade on emerging markets. This had a setup where we could lose very little. But if we did get a sell-off in the stock market, we were poised for quite a return on emerging markets. And so far, this has not played out. We entered the option collar when the emerging markets ETF was trading at 43.03. And current trade price, when I took our screenshots today, was 44.35. Now, we had sold an in-the-money call option and purchased a near-the-money put expiring December 20th. Entering the trade, we collected $1.75 credit, and the current value is negative, or a debit, of $3.29. So the net open profit is 25 cents negative, or a loss of $950. Now, here's the most exciting part of the day. It's not normal for us to hit a win on the TLT and the SPY on the exact same day. This trade, we actually did not sell a call option. My expectation is the TLT is going to travel dramatically higher until the Federal Reserve hits near 0% interest rates. And we can see that in the news. I'll explain why the TLT has become an extremely attractive investment for banks like JP Morgan. And it wasn't nearly as attractive until the Fed made a big move in September, and now they're accelerating that move. So it's almost too good to be true. It's not fair for sure, but it's just, that's the way it is. So we have to keep that in mind with our trading plan. This trade setup, we purchased a in-the-money put option, essentially limiting our loss that day. We actually entered our maximum loss for that position the second we put on that put option, and we're already up. So that's great. Essentially, we paid $2.41 for a put option expiring January 10th, 2020, in expectation that the TLT could potentially go up to probably around 148 in the near future. So that's a huge move to the upside, and something we didn't want the call option to offset, to essentially limit our return. So this trade, I will help new people jump into each Thursday. But if you're already in this position, we have ample downside protection. And we'll try to time selling that put for whatever we can get out of it. But essentially, we're now in the money. Let's look at the audit on this. So yesterday, TLT was at 137.09. Today, it was trading at 139.27 when I took the screenshot. By the time I finished the trade doc, I believe it was up even more. The big picture is TLT potentially could go to 180, and I'll explain why in a moment. The option caller in this case was just a put, so it wasn't actually an caller, it's just a long put. Cost us $241. Its value right now is $1.20. This leaves us with a 98-cent profit per share. Now times 3,800 shares is a net profit of 3,724. So for those of you who've been sitting on that darn TLT, you know, we made a lot of money all year with it. The last few months have been rough, but the big news flow coming, I think, is going to be very beneficial to the TLT, especially now that we're immediately jumping into phase 2 of the trade deal. Now, Dawn, I see your hands raised. Do you have another question? And if anyone has questions, please feel free to interrupt. I do know it's the way we go through this is very meticulous, and a lot of our members now know this like the back of their hand. So I appreciate everybody who has been a member going through the whole spiel each time. Okay, GDX traded from, we did the same setup where we did not sell a call option. My expectation for GDX is much higher, especially with repo going into full throttle and phase 2 most likely causing some issues in 2020. So we had a 27.46 entry point on GDX yesterday, or that was the trading price when we removed the option caller and rolled into a long put. The current value is 27.67. Now, once again, I would not expect to see a profit on the SPY, TLT, and GDX on the same day. Our system's designed to try to lock in profits on one side of the trade and then catch a move up on the other. And so we'll look at why everything's melting up right now. This trade setup cost $1.15 to give us downside protection until January 10th. And so once again, the second we put this trade on, we began with the maximum loss we could potentially have in that trade. That's because we purchased an in-the-money put. Now, luckily, it has traveled up, and our put option minus the appreciation in value right now is about break even. We're net 5 cent up or 190 profit. So that's just getting beyond the break even point. Now, next in the trade setup is the updated P&L with all of the open positions accounted for. So that means I have to go look up every option price that we're long or short, update it in the spreadsheet, take the screenshot, and compile this for you every morning. So it takes a good hour to do. But once again, we have by far the most superior accounting system. This is hedge fund level accounting and strategy. So you can see our returns. What I want to point out at this point is risk to reward. I'm not trying to beat the SPY. If I want to do that, we would be toggling all our money into the SPY and then trying to guess into the TLT and then jump into GDX. We wouldn't be having a balanced portfolio that's attempting to reduce volatility. So my goal is actually to generate return with low volatility. And we've done just that. We've delivered a maximum loss of $1 for every $14.62 derived. That's a very nice risk to reward ratio and far greater than you could have had with the SPY. If you look back to October of last year, the SPY's really gone nowhere. It's up a few percent and it's given you volatility of around 18% in December and 8% in May, another 8% in August. So it's really not been a great risk to reward ratio to trade the SPY over the last 2 years. And it probably will continue to struggle to deliver a low risk to reward ratio. So our investors appreciate low volatility, maximum loss of $1 over the course of a year. We've generated over the course of 13 months, that is, a profit of 1462. And I guess we did start mid-December, so we're officially at 12 months exactly today, actually, is when we began. Okay, and then you get your total return per portfolio strategy, how the capital's allocated.
And that's minus dividends, just to.
And I'll add in the dividends. Everybody's want to know. We'll probably have an extra basis, an extra 1% gain after adding that. Now, the next thing I do is I screenshot with the current open positions or P&L per strategy, as well as the homepage screen of our portfolio. Now, note there are other assets that we could potentially trade on that trading period, but that's after a big reset. And we're nowhere near that. We're probably a year or two off from the beginning of the reset. And if we have time today, I'll review what that is. But once again, this is updated daily. So you know exactly what's going on in all 4 positions at all times. So I'll skim through that. Note that all portfolios individually have much greater degree of volatility and far more months that have generated a loss. It's when you combine all the strategies that it really smooths out your return and creates this extremely low volatility result. Okay, so that goes down. After that, I like to show off our returns when stocks have volatility. It's really what makes our program stand out. We're not beating the S&P 500 when it goes up, but when it goes down, we usually make money. So far, in every time it has, we've done very well. After that, I'm going to just show you how to fill out the trade. For those of you just getting started, you're not familiar with options, this makes your life very easy. Here's how you close the previous position, and here's how you roll into the new position. And it will be just like that, like clockwork, every day for you, exactly at noon Eastern. So that's a good overview of how the trade alert looks. Okay, what I'd like to do now, first I'll see if there's any questions, but probably what a lot of our members who probably keep joining us live really like is the news I collect. I do probably consume at least 8 hours of content a day, whether it's interviews from YouTube or special written pieces. And then I collect the best of the best and put it into a single document to review what's important each day. So before we jump into that, do we have any questions out there? And it's funny, we tend to get one person each day who's willing to chat with me, and the rest like to be quiet and listen. No problem. James, are you feeling like this is something you could paper trade at least?
Yeah, I'm just, I need to learn a little more. That's all.
Yeah, so you might actually be a good candidate for our boot camp. I'll try it. If I have time, I'll overview what's in our boot camp. All right, let's take a look at the news. And we'll start looking at why is that TLT so sexy to JP Morgan. Okay, Donald Trump, we have agreed to a very large phase 1 deal with China. They have agreed to many structural changes and massive purchases of agricultural product, energy, manufactured goods, plus much more. No, they haven't. The 25% tariff will remain as is. Now, China demands that's removed before they do anything, with 7.5% put on much of the remainder. So that's the September tranche. That was a 15% tariff. He's cutting that in half. The penalty tariff set for December 15th will not be charged because of the fact that we made the deal. We will begin negotiations on phase 2 of the deal immediately rather than waiting until after the 2020 election. This is an amazing deal for all. Thank you. Okay, now usually I do China data first, then US business, then politics, and then charts. Today I did pull up some other highlights that are potentially going to probably take mainstream attention for the next few weeks. New Fed repo schedule, one word, massive. A few words, the largest series of repo operations ever. The Fed announced its repo operations schedule for the next few weeks. It's huge. Here are my calculation. There are 2 existing 25 billion term operations over the turn already in the market, totaling 50 billion. The Fed committed to at least 150 billion overnight operation on year end, and a reg start year end operation on the day before of 75 billion. Between now and year end, a total of 6 term repo operations totaling $225 billion. Plus, they put in 320 on the balance sheet. All total, I count Fed committed to pump 500 billion into repo market over year end. Okay, so what does this all mean? What on earth is going on? And so yesterday, I spent a good 4 hours listening to bankers from JP Morgan, Fed heads. What on earth is going on? Why do they need to borrow so much money for overnight lending? Overnight lending is supposed to be a risk-free way for banks to make free money. And so the bottom line is that they have become overloaded in treasuries. So the way the whole treasury market works is treasury issues debt, primary dealers buy the debt, and then they distribute the debt. And they've been able to sell the debt for an immediate profit, but they're not. And you got to ask yourself, why are the primary dealers hoarding treasuries? As you can see, it's at an all-time high. And so essentially, here's what's happening. Since the 2008 crisis, a lot of regulations have come in that do not allow the banks to overlend the capital that they have on their balance sheet. So it's turned into a situation where the broker dealers are wanting to get a line of credit from companies like JP Morgan to then lend to big hedge funds. And this is just one example. And the credit's not available. Their funds are locked up. And so essentially, here's what's happening now. JP Morgan's getting a sweetheart deal. Step one, they purchase the debt directly from the Treasury. And they have to. That's why they're a primary dealer. That's part of the deal. Step two, rather than just flip it for a quick profit into the market, which would probably cause yields to spike because they have $200 billion worth of these treasuries right now. Instead, what are they doing? Well, they're taking this money and putting it into the repo market. So they'll get it back, but what they're getting in turn is cash that they can then go loan out and generate profits. So from their point of view, they understand that yields are most likely traveling lower. That means the value of these bonds are going to appreciate the longer they can hold them. What are they doing? They're buying the bonds. They're not flipping them. They're putting them into repo, and then they're making more money with the cash that the repo market's handing over to them. So it's quite a sweetheart deal. Imagine you get paid the interest on the bond. You may see a huge profit if the yield goes down at all, which is almost surefire to happen. And in the meanwhile, you get pure cash that you can then go out and loan it for a huge profit to hedge funds. So there you go. That is why treasuries have become extremely attractive as the Fed has begun repo operations. And most likely this will continue. Now, at the same time, the Treasury is picking up the front end of the Treasury market for massive profit. We'll look at the yield curve in a little bit, but that front end, the value of those bonds have gone up significantly. And now the Fed is vacuuming those up at $60 billion a month. So the bottom line is the bank's balance sheets are becoming very clean at year end. And this could be a massive melt up in a lot of assets. Okay, so here's their schedule. All you really need to know is this is not slowing down, it's growing. In September, they told us this would last a week or two. Well, it looks like it's not going to ever stop. If you did study their FOMC minutes, they're talking about a never-ending standing repo facility, essentially just to do this. Let's see, let me get that one. I'm not sure where that came from. Okay, so now we got some other tweets. Zero Hedge says, while Congress is impeaching Trump, the Fed is quietly bailing out banks. And then Luke Roman says, well, I would amend this slightly to, while Congress is impeaching Trump, the Fed is quietly bailing out Congress via the banks. So you got to remember who's issuing all this debt and why is it overloading the banks? Well, the government is creating massive deficits, and that's why the Treasury built up such a surplus and needed the Fed to intervene. Otherwise, what would they do? They'd try to sell all that and yields would spike. With yields spike, stock market crashes, and a whole host of problems occur. Government's not funded. And also, if our yields did spike, imagine what would happen to the $14 trillion of negative yielding corporate debt, or rather sovereign debt, across Europe. It's going to drag those yields higher. They're going to be sitting on massive losses. So we could see credit markets around the globe crash and just pile into high yielding US debt products if that were to occur. But it'd come at the cost of all stock markets crashing, because now you don't have your corporate credit buybacks. Here's a look at your balance sheet. Record pace, projected to get past our all-time high from 2016 by mid of January. And that's just from the year-end repo. That's most likely going to continue growing. So this is happening very quickly. Breaking: China and the US have reached a consensus on the text of a phase 1 trade deal on Friday, China's Commerce Ministry. Now, this was interesting this morning. The Wall Street Journal story on the China deal is completely wrong, especially their statement on tariffs. Fake news. They should find a better leaker. Kyle Bass, probably not too happy today. China's companies binged on debt. Now they can't pay the bill. This won't be a problem thanks to the MSCI and Bloomberg indexes adding China. More suckers being brought into the China team. Investors will never get their money back. Trade war, Brexit, those are not the actual drivers of the slowdown. Too tight Chinese and partly also US monetary policy is the actual reason. The money growth in China is not supporting the rebound story. And so the bottom line for China's money growth is that they have gone to 212 trillion yuan over the last 25 years. And they claim that those are worth 7 to 1, so 7 yuan for $1. But that's kind of a joke because no one can actually trade their currency. 75% of their trading volume on CNY is just converting into the Hong Kong dollar, which they own as well. And then from there, that's where the leaders in China are able to get money out of China. What do? They go buy real estate, they buy gold, diamonds, things of that nature. And so China's strategy to target GDP growth over the last 3 decades has revolved around essentially the Bank of China printing all this money. And the first step is the provinces who are assigned a certain GDP target will back calculate how to get there. They flip some communist land, which is not able to be part of a corporate business. They turn it into something they can sell to a construction company. Construction company takes a loan from Bank of China and goes and builds massive cities, tunnels, bridges, houses. They have at least 10 cities the size of New York abandoned. They didn't finish them and they're just rotting away. You can see little Chinese people riding their bicycles through these 8-lane highways. There's no cars. They've built 50 million luxury condos that were not completed, just cement, concrete blocks. And then what do? They turn around and they sell it to the people who live in China. They're not allowed to buy anything else. Chinese can't go invest wherever they like. There's a few pieces of the stock market locally they can invest in, but really their entire national push is driving the Chinese to not just buy one house. They're now purchasing second and third homes, and they're not renting these houses out. They're not even completed. So this has stopped working. Their debt to GDP has exploded. And so now they're trying to have a soft landing. My expectation is they won't be able to pull it off.
Hey, Jason, Don Nelson has his hand up.
Hey,
Don,
Don,
go-
got a question? I think your mic's muted.
Yeah, and Don, if you want to unmute your mic, scroll down to the bottom of the screen and then look to the bottom left-hand corner and just click the button that looks like a microphone. And once you click it, it will unmute the mic so you can speak.
Let's see how our trade alert's doing well today. We're almost at a max profit on the SPY. And TLT's hanging in there. It's sold off a little bit. Okay, yeah, if you do have a question, Don, go ahead and unmute. I'm going to continue. Wang Yi, the U.S. has used various international occasions to vilify China's social system, development path, and mutually beneficial cooperation with other countries, and charged China with all kinds of unwarranted crimes. Chinese officials at the annual Central Economic Work Conference have agreed to set a growth target of around 6% for 2020. So, yeah, you know, they just decide what their growth should be and then go ahead and engineer that. It's a closed system. There's no free market. No one's finding prices. If they were to actually open their economy, money would flood out. And so it's been a trap. Money comes in, but it cannot ever come out. They have strict capital controls. It's not just Bloomberg, Reuters, and Refinitiv is now blocking router stories critical of Beijing that could jeopardize ICON or whatever it's called now. So Bloomberg and Reuters have both blocked any negative stories about China because they do so much business there. Think of the NBA. China is now able to create censorship outside of China because people want access to its markets. But you can see the slowdown in a number of metrics with China. We have some big presentations on this in our boot camp program that you can rewatch. Year-end change in China vehicle sales continue to crash. Now, China's data, no one really trusts. That's why we like to focus on some of their trading partners. So South Korea is a good canary in the coal mine. More so is German. And while we've seen the German 10-year yield spike, European banks are not. And so today we did see that yield. This was last night. Now today we're seeing those yields start to come down. That's why the TLT is back up. 156 US companies issued bonds in euros, which the ECB is now buying at low interest rates. Subsequently, the US companies use the money to buy their own shares. The ECB is effectively boosting the US stock market. And so Microsoft actually gets paid with negative yielding bonds to issue them. And a bunch of our top tier companies in the SPY ETF, almost all of them are able to actually get paid to borrow and buy back their own stock. So that's why we want to be careful about trying to short the stock market until this corporate buyback scheme comes to the end. And it won't come to an end until rates spike one way or another. Bank of America, it is true that without corporate buybacks, 2019 would have likely seen a US profit recession. Oh wait, and I didn't notice Jim doesn't have his microphone unmuted. Hey, Jim, how's it going?
Hello.
Okay, let's see. Strongest negative correlation between gold and yields ever. Completely unsustainable. The Fed's printing machine is officially on. Gold probably at early stage of a bull market and yields likely bottomed. I don't think yields have bottomed, but I do think that gold is getting ready for a long rally. Here's this correlation. 2018, the Fed hiked 100 basis points. Global earnings per share grew 8% and equities fell 11%. In 2019, the Fed cut 75 basis points. Earnings per share grew 1% and equities rose 20%. That's why we throw all those economic indicators out the window and focus on central bank policy in our program. They are by far the single biggest factor in predicting markets. Business debt eclipses household for the first time since 1961. People like to say we have the best economy ever, but here's the analogy. Imagine you started a little business and decided to go open a high interest credit card. And then you go take your credit card and you go buy a bunch of products from yourself. And then you report that you're making money. Well, have you really made any money? Unfortunately, that's the general problem, is that we're growing US debt closer to 6% and growing our GDP at 2%. And if you do study a lot of these strategies that believe you should print money in a slowdown to grease the wheels, well, the whole idea is that that money will get bounced around so many times and make every dollar of debt create multiple dollars of GDP growth. And it's only when you get buried in too much debt that the opposite occurs. And so in China and the US, this is certainly the case, that to keep these positive GDP numbers, they have to grow their debt at a faster rate, and that is not sustainable. Here's the look at $120 trillion in US household balance sheets. Not a lot of cash in there. This is probably the bigger scare in the long run. If we go back to Japan, 1980 through 1990, we look at Elizabeth Warren and her threat of a 2% wealth tax. I think that's unconstitutional and unheard of. In Japan, when their market crashed in the 90s, in a sudden move, they took anywhere from 50 to 90% of all bank accounts that had over, I think it was $10 million. So how would you like that kind of a wealth tax? And so the bottom line is, as this continues to grow, the risk of poor folks taking over their government and stripping the wealth away from the rich is more and more likely. And that's why we've seen every billionaire under the sun for the last few years, who of course are well versed in history, going out publicly. JP Morgan's Jamie Dimon, Bill Gates, all of them, Ray Dalio, they're all talking about how we got to take care of. Buffett has a funny story. If the family's doing well, the prize winner should get paid the most. But if you got a little brother who's not keeping up, well, of course we got to take care of the little guy. Or Jamie Dimon's talking about how we got to get better social nets. Ray Dalio saying capitalism's broke. All they're really saying is they don't want to have their billions of dollars stripped away from them. So this trend continues to grow. And it's all caused by the way the banking system is designed. It rewards the asset owners and the banks, and it does not reward the labor force. For every $100 of extra income, the bottom 50% of households spend $137, while high income households spend just $52. And that right there is the bottom line with the problem with the American economy, is that we're sure our consumers are strong, but it's just because we continue to grow their debt. We'll take a look at how long this can be withstand based on where we're at with Fed policy currently. The long view, I like the fact that a billionaire is using his media empire to smear other candidates. Seems much more egregious abuse of democracy and independence of the free press than paying off an extortionist. Now, Bloomberg came out and said no negative news on China and no negative news on any Democrats, but go at it with Trump. Hush money, obstruction of justice, a porn star payoff. Can't keep all the Trump investigations straight. We built a handy interactive guide. Trump, how do you get impeached when you have done nothing wrong? A perfect call, have created the best economy in history of our country, rebuilt our military, fixed the VA, cut taxes, regulations, protected your Second Amendment, created jobs, and so much more. Crazy. So we should probably see the House vote maybe tomorrow, maybe next week, and this will be in the Senate by January. I would say this is most likely why Trump caved on the tariffs and wants to get past that. So potentially we have some smooth sailing in equities, hopefully, until some point after the Senate trial. Then I would suspect we may see some aggressive rhetoric against China if they're not doing massive agricultural products, and they may not. Because if China wants to have easier geopolitical relationships with the US, that obviously Joe Biden or Bloomberg would be a better choice. So far, Joe Biden's polling the best. Elizabeth Warren's, actually, I've got a neat chart. Let's go jump to that. Now, again, if you want to predict up on stocks, well, a good thing is to look at, is the government creating a deficit? Because if it is, that makes GDP go up. And this can only go on for so long. We'll look at how long in a moment. But the bottom line is that debt growth creates positive outcome for stocks. This is a great chart. Elizabeth Warren hit 50% for some time and has now crashed down to 15%. Remarkable. Joe Biden is now in the lead. I suspect, depending on how the Senate trial goes, that could get ugly. They may wrap it up very quickly and get it over with. And I think Hillary Clinton might put her name in the hat soon. So we'll see. Pete Buttigieg continues to be a great speaker, but he looks like a young chap, and his only credentials are, I think, the mayor of like 115,000 person town. But he does debate very well. Bloomberg just doesn't seem to have the right appeal to the Democratic audience. And we'll see if this becomes the case or not. Matt Gaetz, the people that will be regretting these impeachment proceedings are the Democrats in swing districts that aren't going to be reelected. I'd advise them for the upcoming year in DC, rent, don't buy. Okay, now we're looking at charts. SPY ETF, without any fear, is most likely going to travel substantially higher because of the repo madness. When you give banks $500 billion line of credit and they go and turn around and give that to hedge funds, the hedge funds leverage up and they do exactly the same strategy we are, which is a long stock, long bond strategy. So potential melt up in the SPY is absolutely in the cards. Is there still some fear? Certainly. Now they're talking about phase 2. If China doesn't start buying agricultural products, I could see Trump losing his temper. But he may just try to keep the coast clear through the election. And if the economy is not in a recession, he's almost guaranteed to be reelected. So we'll be playing relatively bullish trades on the SPY with caution. What's a good range? What's a good warning sign? Well, the last time we had serious problem for the stock market was when the 10-year yield hit 3%, actually went above that, went to about 3.3. And that's when it was just too attractive. Why risk money in the stock market when you can get a guaranteed 10-year yield that, it's a great yield. 3.3 is greater than the inflation expectation of 2. So you can leverage into that all day, generate safe income for your portfolio. So the banks love that. But more so than that is the expectation that that yield's just way too high and that it will go back down. So now you can generate yield for a year or two and then flip the treasury for a huge capital gain when you understand what's really happening with the credit markets. So that'll be our biggest signal to be worried about stocks will be when either the low end of the corporate credit market starts to snap, or if our 10-year, 20-year, 30-year yield started to perk above 3%, that could be a problem. But that's just so unlikely to happen because now the banks are getting a sweetheart deal to buy treasuries, loan it to the Fed, and then they get cash. So it's like they have twice as much capital for free. So my expectation is we're going to see quite a melt up in both these assets going into 2020. Here's a look at this. We got a question? Okay, I'll continue. This is just a closer look at the SPY. A little bit of a sell-off this morning and a rebound. The general concept you need to know is that there's more funny money in the markets right now than ever before in history, and it's accelerating. And at the same time, China's economy is really crashing, and they're not trying to grow their debt because they don't have an economical way to do so. They found that building bridges and airports and empty houses and ghost cities is not a profitable venture. So until they can find a productive way to put 1 billion people to work, they probably won't grow their debt. So the bottom line is China's slowing down. It's causing trouble around all of their trading partners, and that's pushing money to US assets. Here's a look at our TLT. And again, I think this can go to about 180 before interest rates get near zero. And that's when bond market buyers have to, you're not getting a yield, and now there's no chance of capital appreciation. So at some point, that's where bond market's gonna realize the game's over for that. There'll be time for rate hikes. So that's still a substantial rise ahead for the TLT. Emerging markets ETF tapped up to the high of April 2019, but nowhere near the high of mid 2018, where it was around 52. So most likely we'll be trading the upside of emerging markets while the trade deal is in a de-escalation mode come Tuesday. We had a bearish trade this week just in case things got nasty with the tariff deadline on Sunday. So I'll always play the safe side rather than be overly optimistic. Here's your longer term chart on emerging markets. So once again, if China really does gain access to capital and does begin that massive Belt and Road project, they could certainly goose their GDP as high as they like. Again, as it's all their own numbers, they pick their own prices and sell everything within themselves. There's no free market whatsoever. But the bigger picture is emerging markets has access to 2/3 of the population. And so there's a tremendous room for growth, despite all the downsides with the legal structure in China, with the lack of transparency in their books. Besides all that, the potential for growth is tremendous. Companies like Alibaba, Tencent have some tremendous unfair advantages in Asia, and those are some of your biggest positions in emerging markets. Now, after the election, I would suspect the trade war does go into full battle mode, but I could be wrong. It could happen sooner. They're already talking about phase 2 beginning immediately. And I think if they don't buy agriculture products, that will be what really lights the fire on phase 2. Here's a look at GDX. So the last time we did quantitative easing was at the end of 2008. Immediately stocks rebounded. It's the same scheme that we're seeing right now. The banks buy bonds. The Fed buys them for a massive profit as they cut rates, driving the value of those bonds up. And then the banks get to buy stocks at a discount. Now this time around, they're pulling the whole scheme at all-time highs. So now we're seeing the banks get bailed out of their bond position for a big profit. In fact, it's a little different. The repo is adding a whole new twist to how this is working out. And I'd say it's even more lucrative for banks in this setup. Okay, GDX again. This was primarily from a housing crash in the US that caused a big jump in debt. In fact, during Obama's administration, we doubled the federal deficit. So that's the kind of spike you got in GDX just from a small housing crash in the US. I think it was total like $200 billion that was at risk. The amount of money that's been misallocated in China is in the trillions. And so as that slowly gets worked out of its economy and all these valuations get lowered, the amount of money printing to support this global problem is going to be massive. So we're trying to service $266 trillion of sovereign debt globally. And bottom line is they're going to have to print a whole lot of money to service those debts If the money supply grows, the relative value of gold goes up. So if gold's going up, you want to own the gold miners. It's not very often that gold can be a good part of our bullish thesis, but right now, more so than ever, it absolutely is. So you can see we've had a little bit of a sideways move for the last 3 months, but now it's official. The QE is ramping up. That's when you want to be long gold. This is an interesting OTC stock I've identified. One of the fears that China could pull is that they might cut off the US from rare earth products. And so they've really monopolized that market by essentially being willing to pollute their country more so than any other country is willing to do so, to gather these rare earth metals. But there's a few companies, one in Australia and one in the US, that can actually mine these metals. And there's one specific metal that's extremely rare and important for military use. And so I have seen this stock popping up significantly recently. So that's a very interesting development that I'm just following. It's a little tiny OTC stock, so I'm not recommending to go buy it, but it's something to keep an eye on. Here we have the Chinese currency against the dollar. So it did strengthen for the last few months on this good news. And our expectation is to short this currency in our boot camp program. We're glad we waited because we'll get a much better entry point. I'm going to wait a few more weeks before we pull any triggers on that. But the big picture is that unlike Japan decided to give up its aspirations of becoming the superpower of the world in the 90s. They're valuing Tokyo as more than all of California. And once their bubble collapsed, it was from real estate just getting too expensive, cost of labor going up. So corporations got the hell out of Dodge, actually started going to China. And they decided to protect their bond market and currency market at the cost of no GDP growth, negative returns in their stock market for 30 years, and a collapse in real estate value. Now, they're on a tiny little island. That makes sense. They're exporting a lot of products, and they're also exporting the value of their money to purchase assets worldwide. I don't think China's make the same decision. China, most likely, who's printed 210 trillion of these CNH, they claim they're worth 7 yuan for $1. And I don't think they're worth anywhere near that. No one does. And that's why no one trades in their currency. So my expectation is that they will want to protect GDP growth and jobs in their stock market, and they will potentially allow their currency to slowly devalue so that they can spend it. If people don't want to buy a yuan for about 12 cents is what they're worth right now, then maybe they'll buy it for 6 cents or 3 cents. So if they want to actually be able to spend their currency to buy oil, steel, everything they need to build their Belt and Road Initiative, well, they're going to have to open up this currency slowly but surely and let it find its real value. So I do suspect in the long run, this will be devalued significantly. And you can see that's what's begun. Really, since 2010, their strategy snapped. Their GDP growth went well below 10, and it's never rebounded. And so there's been tremendous pressure. Everyone's trying to sell whatever CNH they have and buy anything but their local currency. And so you can see there's been quite a devaluation from 6.2 to 7 over the last 5 years. I think this trend will continue substantially. Now, the Hong Kong dollars, your Kyle Bass trade, this is actually a safer way to bet against China, where they do manipulate CNH up and down, as you can see, for short periods of time. The Hong Kong dollar is designed to do that, just to match the dollar. The bet here is that China's reserves will run out of cash and that they will give up on protecting this exchange rate. And Hong Kong is short $1 trillion. So if Hong Kongers were to try to sell their dollars at once, they'd be short by $1 trillion. So this did tighten slightly and gives us a better entry point for that trade as well. We'll still wait a little bit longer to enter that trade for a boot camp. And you can see that slight pullback, 5 cents to strengthen. Here's a big picture in gold. Bottom line is the more money created globally, that makes the relative value of gold, which is not being created as quickly, go up. And so that's just as simple as that. And right now we're printing money and lowering interest rates at record pace, faster than ever before in history. So that's why we're long gold. I keep a look at crude oil prices. If prices of oil get too expensive, that creates inflationary pressures. And if crude gets too cheap, that signals problems for the stock market and low growth. So right now it's at a safe price. The 30-year German bond is a great way to predict American bond prices and also the health of China. Now you can see the obvious trend on this chart is as if there's gravity pulling the 30-year bond lower and lower. We've had a little bit of a bounce on all this trade optimism, but the big picture continues to be that this will go back down. And you can see, even with the positive trade headlines today, that yield is still going down as there was really nothing accomplished with the phase one deal. Now the German, or rather the US 30-year is not in such a negative slant, but it just gives you a feel for where we might drag our yields, and they could go substantially lower. So just to get back to 2 would probably put us well above 148 on the TLT. I'm expecting we could push this potentially as low as 1.5 to 1, depending on how low the rest of the world goes. We just need to keep our yield attractive enough to continue driving foreign investments. We're not completely funding US government with JP Morgan. And there's that quick little nosedive in the yield this morning, which gave us a pop on the TLT. I keep a look at Bitcoin. This shows that people are trying to get out of local currencies, especially with capital controls. And China is doing everything they can to keep money within their borders. Now they do control 2/3 of the miners. So that's interesting. But these prices are still very elevated, showing that people are still trying to escape their currency because they're facing inflation. So the value of their money is losing value quickly. China is facing 4.5% inflation. So it's a big problem. If you're a Chinese fellow making $11,000 a year on average, you're getting taxed at 70%, and you're seeing your cost of food go up 4% a year, you're not going to be so happy. The dollar's rallying this morning after quite a sell-off yesterday. Big picture is that there's so much debt denominated in dollars overseas that just to manage the interest payments, it's over $12 trillion in corporate debt outside of the US. Just to manage those debts, interest payments, they have to convert local currency into the dollar. And that's what's been causing the dollar to remain so strong. And that's just the general theme, is that China's slowdown is hurting everyone else in Asia, and that's causing all of their economies to suffer. That's why we're seeing negative yielding debt, 0% yielding debt, and everybody's currencies are quickly losing value against the dollar. And last but least, our yield curve. So yield curve is looking at the different, the 1 month, 3 month, 1 year is your T-bills, 2 year, 3 year, 5 year, 7 year, 10 year are your notes, and then your bonds are the 20 and 30 year. We're playing the long end, the 20 year, 30 year with the TLT. And the bottom line is the front end has been shoved much lower by the $60 billion a month asset purchases by the Fed. And my expectation is that the long end will move its way down over the course of the next year. And this means TLT will go substantially higher. And I also suspect this front end can go a bit lower as well. So I think in general, this whole yield curve will be slowly sinking as we feel the real effect of China slowing down next year. And their GDP growth will quite likely be substantially less than 6%, even though they say they're targeting 6%. All right, let me just pull up a couple slides and I'm going to pass this back to Dean.
And folks, is there any questions out there at all? Please feel free to jump in, unmute your mic, just go ahead and talk out loud or type into the chat box, whatever works best for you.
Okay, so what I'm going to show you guys now is our different trading plans based on what's going on in the trade war, really. But more important than the trade war is what's happening with central banks. Central banks have been lowering interest rates. They did so 3 times. You know, they say they're on pause for now. We're in a low inflation environment, which is because corporations are borrowing for free and they're competing with other corporations who are borrowing for free. So to compete and take market share, the only way to do that is to sell goods at a loss. So we have a whole host of corporations who are driving inflation lower by borrowing tremendous amounts of money to take over market share with the hope that they could raise prices in the future to generate a profit. And so inflation's probably not going anywhere. The real problem will be when interest rates get near zero, all of a sudden the game's up for the bond market. So in a low rate, low inflation, quantitative easing environment, we have perfect conditions for a bubble. And so you can see with this setup, I'd like to be long SPY, emerging markets, TLT with the plus signs. And this is if the trade war is up in the air. We don't really know whether it's going to be solved or not. And in this setup, we're relatively flat on GDX. So we're protecting it, but we're not limiting our upside. So that's why we have that long put. Now, if the trade war escalates, we know what happens like clockwork, at least for a short period of time. We get a sell-off in stocks, and we get a big bounce in bonds and gold. And I'll show you how we optimize our option collars for that. We're not going to change what we own. We're just going to change the options. And in a de-escalating trade war, we get the opposite. We get a big rally in stocks and a short-term sell-off in the bonds and gold market. Now, that's not changing the overall picture that these assets are all likely to bubble higher. But it does change how fast the Federal Reserve will cut rates and get to zero. And that's when the game's up. So let's just look at our 3 trade setups, and then I'm going to go ahead and wrap up my part for today. I have a lot more content that is very valuable to you that I'm not going to be able to finish. So in our boot camp, if you really want to take this to the next level, that's where we go every week with 2 webinars. So, okay, bullish loose option collar. We sell an out of the money call. We buy an out of the money put. This protects us from the downside. So we have a set maximum loss. It also caps off how much we can make. So essentially financing downside protection by selling a call option. In this setup, the underlying asset delivers the profit. The options lose if we're right. If we're wrong, underlying asset loses value. The options both go up. Neutral tight. So if we think the market's probably not going any higher, but has a high risk of crashing really hard, I like this setup. It's a tight option caller. We're selling an at the money call. We're buying a near the money put. This means we are going to derive most of our profit from the call option, losing time premium value. And so in this setup, the SPY can go up or flat. We hit our maximum profit. If it travels a little bit lower, we break even. And if it goes significantly lower, our maximum loss is very small because we have a near the money put. Now, in this case, most likely your call option derives profit, your SPY maybe goes up or breaks even, and your put option loses value. That's if we're correct. Now, again, if we're incorrect, SPY loses value, options show a profit. The bearish inverted option caller sells an in-the-money call and purchases an in-the-money put. In this setup, we're going to derive all of the profit from the short call and the long put. And this is one of our favorite trades. We just rarely get to put it on, at least at this point in the business cycle. So we still have some rope for the Fed to push bond prices lower and keep all of this tied together. So we're at 1.75 on the interest rates. Once we get to 0, the game's up. But here's a look at our bearish setup. And again, we sell that in the money call, buy the in the money put. All right, guys, I'm gonna go ahead and push the screen back to Dean and answer any questions. Let me know if you're ready to take over the host.
Yeah, that's any questions, guys? Please feel free to jump in, please. I know that's it's a wealth of information, right, in a short period of time. So I definitely want to please encourage you to ask questions. There's no such thing as a stupid question, okay? And you're only going to benefit yourself and your hard-earned nest egg by asking questions.
And also remember, if you do go back to Trade Alert email in a couple hours, the same link you clicked on to join this live will provide you with a replay of today's presentation. And yeah, so we went for about 2 hours. I barely hit the tip of the iceberg of what we have to provide to you guys. So there's a lot more. You can see that was about 5 slides out of a couple hundred in module 1 of our boot camp, which is a 16 module course that really takes you through the ropes of how to follow our program inside out.
All right. Jason, can you see my screen here, bud?
Yes, sir.
Okay, good. All right, guys. And really, you know, our whole point and mission for this system is to protect your capital, right? And it really kind of goes back to my favorite rule and my favorite lesson I've ever had from Warren Buffett. Okay, and I got this from one of his 7 books I've read. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Okay, smartest and wealthiest investor on the planet, right? So you know, for me, it just kind of cements exactly what the system is designed to do. Okay, so it's all about capital preservation. Okay. And so now I'm going to get to the value we provide to our clients. Okay, and we have 2 options really, and it's kind of up to the person as to what they want to take advantage of. Okay, but really, what most people have picked up is our advisory service option. Okay, and we have 7 commitments to provide an unmatched service, and I'll go over those in a minute. And we also have the boot camp. Okay, and the boot camp, I think the really big thing that we offer that other publishers, other financial education companies just don't even touch is helping you understand how the financial system works and why it's always the best decision to be defensive with your investments. Okay, it's just, there's this online trading academy that's out there. They charge $50,000 for this mastery program, and all the content that they put out there is absolutely free on the internet. They don't teach you anything about the financial system. It's not, you can go read about options for free all you want anyway. What every single hedge fund and every investment bank on the planet is going to do the first day you go start working for them is they're going to train you on how the financial system works. No one else is really doing that out there. Okay, so the boot camp, guys, will take you into a deeper level. It's going to teach you how to fish. It's going to teach you how to tie the flies. Okay, where to go to and why. Now the service, okay, you're going to get this daily presentation as part of the service, so you absolutely understand what we're doing and why. But the service is going to provide, a couple things, and I'll start here. But just think of this kind of service is the option that's the most popular with our clients, and that's going to be what's going to hand you the fish on the silver platter. Okay, the boot camp option, or you can always do both too, and a lot of clients do that as well. William, that's on the webinar, is actually doing both. But those are kind of your 2 options, and you can do one or the other. You can combine both. Okay, so super simple. Now here's a couple things that you're going to need to get the most out of your membership. Okay, you're going to need a brokerage account to follow our trading plan that has option trading enabled. Okay, you can use real capital or simply paper trade. you can see how incredibly easy it is to get your hard-earned money the protection it deserves. Okay. And we give you a trial before you actually make the purchase. And that way you can see, you can test drive the vehicle for 2 weeks without paying for it. What car dealership's going to do that? There's not one that exists. Okay. Number two, you're going to need the ability to take 1 to 2 minutes to follow our trade alerts released daily at 12 Eastern. Okay. These alerts are by no means time sensitive at all. They simply need to be placed before the market closes at 4 p.m. Okay. And guys, I travel a lot, as Jason knows very well, and our members know very well. I've literally placed trades on an airplane after I got down. I knew I was going to be in the air for about an hour and a half while after the trade alert went out. I didn't care. I landed on the ground, looked at the trade alert, looked at the text on my phone, replicated it. It's super easy to follow. I've done it on a boat on the way out to Catalina. Literally done it on an airplane. Been driving in my car, got the trade alert, pulled over, put it in, and went back to my day. And honestly, probably at this point, I'm probably putting in, I would say probably 60 to 70% of my trade application on my mobile phone. Okay, you're going to need a cell phone, obviously, to receive the text messages and trade alerts. I'm pretty sure all of you have one. Many of our clients take the trades on the go from airports, restaurants, in the car, anywhere you have service. And that's going to be, where we have mobile service in the United States and throughout the world is growing by the day and will continue to for the foreseeable future. Okay, it's important to make sure you entered your cell phone number when you sign up for the trial. If you use the landline or emails cell phone number, please email ryan@portfoliobuilder.io and we'll make sure to correct the number and add it to our distribution list. Okay. Number 4, make sure you have an email provider that's in good working order. Okay, we send out these free Thursday webinar invites via email. We also send out the trade alerts via email on top of text messages. Okay, and today, actually, I need to actually update this slide, guys. We actually are doing a live presentation every single day now instead of once a week. We had a really high customer ask, basically, and need for more communication about what's going on in the markets. They love our news flow. They love how Jason covers what's going on in the market and why it's important to our positions. So now we're offering that every single day to you. Okay. Okay. So the following value will be provided to you at no cost during your trial and or membership. Okay. Daily trade alerts delivered at 12 Eastern Standard Time. Okay. Monday through Friday. So every single day, like clockwork, about noon, you're going to get a trade alert. Okay. The trade alerts will be sent via text message and email each day, Monday through Friday. We engineer our positioning in coordination with the financial system and macro environment, and on top of where Wall Street's betting, but we teach you that in the boot camp. Okay. And it's really important to learn and to be able to see that and recognize that. Number 2, we trade the SPY, 40% allocation Monday, Wednesday, and Friday. Now, let me ask the crowd. Anyone know why we trade SPY Monday, Wednesday, and Friday? I'm going to challenge someone to give me an answer here. Anyone out there?
I really can't tell you.
Okay. Well, James, hey, thanks for interacting. So the whole reason why we do that, James, is because the SPY is the only equity in the U.S. markets, period, that has a 3 intra-week option expiration period. Okay. So there's actually an expiration every Monday, Wednesday, and Friday. And that's exactly why we trade on those days. And in that manner, we can use the implied volatility decay and time decay to our benefit. Okay. And that's exactly why we trade it every Monday, Wednesday, Friday. Plus, it's awesome. It allows us to get us a little extra option premium and a little shorter time frame. So it's easier for us to kind of pick up, down, or flat. Okay. Let me ask, did anyone know that there was a 3 intra-week option expiration before either joining our membership or coming to this webinar?
I think your talk may have gone on a little too long.
Okay, gotcha. Thanks, James. Appreciate that. We'll get through the rest of this here quickly. Oops, sorry about that. And let me go back here. Sorry guys, this is my first day using this technology. Number 3, we're going to trade the EEM on Tuesday. Okay. Number 4, we're going to trade TLT on and GDX on Thursdays. Okay.
You still have your whole audience, Dean. A lot of people are just shy. No worries. We know most people like to just be a fly
Yeah.
on the wall.
No, yeah,
You
exactly.
literally kept the entire audience for 2 hours. So I appreciate everybody following for so long.
Yep. Yeah, appreciate it, guys. Like I said in the beginning, time is the only commodity we cannot buy. So we appreciate a little of yours shared with us in the front, and we know as you allow us to share some more time with you, over the next couple of years, that time will be paid back in spades. But we appreciate yours in the front, and absolutely appreciate it. Okay, number 5, daily live video presentations with a live chat to ask questions at 12:05 Eastern, Monday through Friday. Okay, you can access the live presentation from the email we send out each day. Simply click the image and it looks like a YouTube video. Please ask any questions to myself, Jason, or Victor during the live presentation. Okay, and just click on the chat icon or unmute your microphone and jump in at any time. All right, guys, and I'm gonna go ahead and, like I said, I gotta update this number 6 because we are actually we've increased the value we give to our customer base, and we are now doing a live presentation every single day. Okay, so I'm gonna go to my next slide here. Okay, so we recommend replicating our trading plan with $300,000 allocation to start, so that you can make our 1% month target return and pay off the course of the membership in your free 14-day trial. Okay, I've looked through my data a few times this year, and over 30% of our clientele base has made more than the cost of our membership during their free trial. Okay, would love to have you be one of those people, but I completely understand if you also want to do it on paper first. Hey, I understand. The gentleman I know that's following this with the most amount of capital, he purchased the system, paper traded it for about 2 months. Started with $200,000 tranche to start, traded it for a month, was super happy with what he saw, was really impressed by the amount of defense provided to his capital, scaled to 400 the next month, scaled to 800 the month after that, and is now well over $3 million. Okay, that's following this. I think he's close to 4 at this point. Okay, so but let's just say you're going to put 300K into this, either with real capital to test. You're going to buy 400 shares to SPY, 800 EM, 800 TLT, 800 GDX. Okay, to make your life easy, just remember for every 100 shares of the SPY, you want to own 200 shares of EM, TLT, and GDX. Super simple. We try to make this as easy as possible, guys. It's best to only buy the shares the same day as the trade alert is released, so that you can add an extra layer of protection on top of your underlying asset. Okay, so number 1, we kind of structure a very defensive portfolio to start. Number 2, we add the option callers on top of it. So really kind of number 1, the allocation and the balance of the portfolio alone is going to put you in a tank. The option callers on top of that is literally going to give you a parameter that you cannot get outside of. It's a beautiful thing, and it's going to help you sleep at night. And that's one of my favorite parts about the system. Okay, so and at all times, guys, please feel free to call me with any questions you might have, and feel free to write my number down, tape it on your computer, save it in your cell phone, but that's 505-322-7515. And here's to protecting your assets in the safest manner possible. Now, does anyone have any questions at all as far as what we deliver, the value we offer, and how everything works? Does anyone have any questions about that? All right, so a little quiet here. Let's see here. Ronald, I know you've been following this for quite a while. Would you mind just kind of letting everyone know about your experience, what you think? I'll unmute your mic here, and would love if you could just share your experience with some people that we've got 1, 2, 3, 4, 5, 6, 7, 8, 9 potential interested investors. Would love if you would share your experience with us. That'd be awesome. So maybe Ron stepped away from his computer there. William, how's your first week been? I'm gonna go ahead and unmute your mic now. If you're still there, William, let us know how your first week has been.
Good. I have a question about EEM. It's going to go ex-dividend. Is that going to affect us since we have a call that's in the money?
Nope. So we definitely want to, try to hold those assets during the dividend periods, and that's just going to be an added.
Oh, that's
extra
right. We own
profit.
the share, so it doesn't make any difference, does it?
Exactly. Yep. And you will absolutely be reaping that reward. SPY's coming up too. We actually have a bunch of dividends coming up in the next few weeks, so it's a great time to own all these assets, as always. But it's nice at the end of the year to get a nice little Christmas present.
Yeah, I've never owned the shares, so usually I have to scramble to sell whatever I have or buy it back because I don't own the shares.
Right. Yep. And we're going to own these forever. And, I think the dividends will provide, it's just a little bit over a basis point in my portfolio. So very happy about that. So that puts you well over 15% as we hit our 1 year mark here. So
Now, on that previous slide, you said that you had to have 300,000 to replicate what's going on.
well, I recommend 300 if you have it, to just that way you can literally pay off the cost of our service during the free trial, or within a month of the time you have your membership. So that's just a metric I use, and it's just really easy for investors to obviously to join with us if they've made 2, 3, 4 times the cost of the service before they even get to the end of the trial period. So. But no, yeah, absolutely. And I know you started with the 75K tranche. And so that's the minimum allocation for the full service. We also have a light option too, which is just Tuesday and Thursday trades that you can do at 35K. But yeah, I just use that 300 metric as a nice little way to, test it because, our returns aren't massive, right? And by no means do we ever want them to be, right? Because that's going to, massive returns equals massive risk. I don't want a part of that, right? But yeah, no, it's just a really easy way for customers to see the benefit. And the bigger the numbers are, obviously the happier they're going to be. And a lot of customers have asked me, hey, Dean, how do I pull more out of this? And I say, hey, Fred, if you have a 75K tranche, the easiest way to get more out of this is to go up to 150 or, 225, 300, whatever you're comfortable with. And, that process will take some time, William. And I'm sure after a month, you'll probably be scaling up from, 1 tranche to 2 tranches, maybe 3. And then this time next year, I wouldn't be surprised if we have your wife's capital in as well.
The other question I have is that slide that Jason shows with the where the stock is, what he bought the options at. Is that something that is available, or is that something he made up for himself?
Oh, no. So Jason, you want to take back over real quick and review the trade alert email?
Yeah, what's the question?
The slide that you show that shows the stock price, the option prices, and where you settled, is that a screen that is available to us, or is that one you made up just for yourself?
So yeah, that's a screenshot. Let me, I'll flip to my screen and we'll see if I can.
Yeah, but I'm pretty sure you're talking about the trade alert, Don, because I think that's the section of the presentation that Jason was going over. But yeah, you'll see that in the trade alert email. But just to kind of verify real quick, we'll have Jason switch over to his screen again, and we'll walk back through that. Okay.
Okay.
Cool. Anyone else? Don, do you have any questions, bud? Let's see here. Robert Earl looks like you just joined recently. Any questions? Please feel free, guys. I'll go ahead and unmute your microphones. Please feel free to reach out with any questions you may have. Okay. Okay, cool. Yep.
And
it switched back to
Robert,
your screen.
if you have a microphone, we'd love to hear from you. think you might have joined in late. If you do, go back to your email a little later, like an hour, and click the same link. You'll be able to watch the full replay of today's presentation. So let me know when you see what you're talking about. Are you talking about this?
That slide right there.
Right there. So yeah, so this is a software program I have that's really handy, and I use it to design the trade each day. But yeah, you get a copy of that in your email. And all it does is it's a risk graph. So it calculates the outcomes depending on the SPY. So,
Well, it shows you in one slide, it shows you your share, the stock price, the call price, and the put price all in one. Because on Thinkorswim, when I pull up my account statement, it doesn't show me these things together. I can't see, all I can see is what the trade was, but it doesn't show me. Can you move that 100?
Yeah. So I think the easiest way to support that, Don, is or I'm sorry, William, is simply call Thinkorswim and ask them how you get to a risk graph, and they'll show you. Like I said, my Thinkorswim is customized specifically to a professional trader, one of my best friends that I've been friends with for about 20 years. He actually overlaid his exact setup as mine, so it doesn't look anything like any other account I've ever seen. So I can't really help support that.
Okay.
But all you have to do is call Thinkorswim and just ask them how to assess a risk graph for the current trade you're putting on, and they'll walk you through how to get there. Super easy. Yep,
All right.
and they have phenomenal support.
Okay, that's all I had.
yeah. So yeah, this won't do the audit on your returns because it doesn't know what the entry price was. But this is a good strategy for trying to design the right trade to issue. So I only use this to pick the strikes before we issue the trade alert. And that's all I'm using this one for. But yeah, this is a very simple version of Thinkorswim. So yeah, you can certainly do this in Thinkorswim.
Okay, all righty, thanks.
Robert, I see your microphone's unmuted. How are you doing today?
Good.
Did you just hop in a few minutes ago?
Yeah, I just did
Okay, great. So how long have you been following our program for?
about 2 days.
Okay, great. And yeah, so we had quite a win today from their previous trades. This trade's already going up, as you can see, $30 in our favor so far. But yeah, I would definitely recommend after this webinar is over, give it like 30 minutes and go back to your email and click the same. Well, you joined from Zoom. Did you get our trade alert email today?
I believe I did, yeah.
So after we close this out, we're going to redirect that link to show a replay of today's presentation. It was a good one. We did 2 hours of pure content, really teaching the strategy. I walked through the trade alert, showed you how we generated some substantial profits today, overviewed the trade alert today. Now, are you an option trader?
Just beginning.
Just getting started?
Yeah.
Are you currently retired?
I am.
Okay, great. So you'd be able to place a 2-minute trade at noon Eastern
Yes.
consistently? Okay,
Yes.
good. Well, yeah, let me just do a quick overview while we got you here. And then we'll probably wrap today up, but I would recommend rewatching it.
Okay.
So this is our trading plan. Are you familiar with our trading plan?
Just briefly got into it, so not a lot, no.
Okay, sure. So how are you playing the markets right now? Are you invested?
I am. I have a UBS account that's handled by a stockbroker. I don't do much. He does most of it, but I've wanted to get more involved with what I do. Right now it's doing very well, but I have really nothing to no knowledge of what he's doing.
Okay, and Robert, is that a financial advisor?
Yeah.
Okay, what, do you know what he's charging you for a fee? What's your percentage?
I don't.
Okay, yeah, good to look at. And a lot of our clients have $500,000 or more, behind a money manager, and people I've talked to are paying anywhere from 1 to about 2.5%, depending on what they're in and how active it is. But let's say you have $500,000 and they're charging you 1.5%, and that's a lot of money. And you look at you compare that to what we do, and our whole goal is to offer a much higher value daily communication, right? You're never going to get that from your financial advisor. And an option to not only outperform them, okay, the average financial advisor out there has made 4.7% over the last decade. That's embarrassing. Okay. I've done better than that every single year of my whole life. But our whole thing is to get you to, less of a fee structure and outperform them both. And we've been able to do that for 163 clients so far. So
Okay.
definitely, Robert, look through your statements, see what that percentage is. You're probably paying a lot. You probably, let's say you have $500,000 in there. You're probably paying $5,000 to $7,000 a year in that management fee. Okay, and you look at a decade of that or 2 decades of that, it's insane how much you're going to pay for your management fee to get underperformance. So.
Okay.
Now, Robert, do you, so you said you have a personal account you're trading on your own?
I do.
So you've been long stocks, you've enjoyed the rally, but perhaps it was a little bit lucky. Is that kind of how you feel about your return so far?
Well, I have not personally done much. Like you say, it's mostly because I've been afraid to do much for the lack of knowledge of knowing how to do it.
Sure. Well, let me just give you a quick overview. Let me ask you this. Do you have any downside protection to equities?
I don't even know what that means.
Okay, no problem. Well, yeah, let me just give you a quick overview of what we offer. And then I would recommend that you just go to the Trade Alert today, give it 10, 20 minutes and hit play. It's a great 2 hour. I'd say this is one of the best 2-hour presentations we've done. Good interaction, some good questions from our members. But let me just, this is our elevator pitch of what we do and why it stands out. The goal is to generate retirement income while protecting our assets. And so we have a very simple trading plan that's very easy to follow. And essentially we trade the SPY ETF Monday, Wednesday, Friday at noon Eastern, the emerging markets ETF on Tuesday, and then we trade the TLT and GDX on Thursday. And why do we choose these? Well, first of all 4 assets are uncorrelated, and that means they tend to go up and down at different times. This means we're not putting all our eggs in one basket. We're not counting on stocks to go up forever. In fact, we're not even just counting on US stocks. We have exposure to Asia with emerging markets. And furthermore, we understand that when stocks tank, bonds go up. And so that's why we have this 2-to-1 ratio of the TLT against the SPY. And the result is that you have very little, you're not going to outperform the S&P 500. We're not trying to do that. What we're trying to do is generate return with low volatility. So if you look over the last 14 months, the SPY's up a couple percent from the crash last year. So, but to end up over the course of 16 months up maybe 5%, you had to hang on to over 15% drawdown in the SPY. And that's if you look at a 14-month. If you even just start at the very bottom on Christmas, the day after Christmas in December, sure, you're up 24%, but you still hung on to dramatic volatility, 8% in August, another 8% in May. And then, let's not even count the 18% loss you had to hold on to last Q4 last year. And so our program is not going to outperform the SPY. It's just not. What it will do is dramatically reduce volatility. So our goal is to generate a 1% return per month. We've had profits in 11 of 12 months. And this is what's really important. This is what really separates us from the crowd. After you've had a few, once your stomach's turning and you're giving up all those profits you enjoyed, that's when people seem to really gravitate to our program. Largest drawdown throughout all this volatility in the last 13 months is 1%. So essentially, we're delivering $1 of risk for $14.50 of profit over the course of the last year. We never lost capital over a 90-day period. And specifically, this strategy does extremely well when stocks sell off. So if you have captured a huge gain in stocks and you're worried about a pullback, you want to play it safe, protect the capital you have, you're going to find that this program does just that. And so in December, when the stock sold off, we made 1%. When the stock market went up, we're not losing, we're just underperforming. And that's by the nature of having half our assets in stocks and half our assets in bonds. May, big sell-off. Who knew that it would end and just go right back up? We certainly didn't, but we had a 2.2% return. August, in July, they told us we had the risk of the trade deal breaking down. That's the only month I lost money. I positioned us to generate a bigger profit if it had broke down. It didn't. And then in August, they caught us off guard and it did break down. And that might be what happens in the next month or two with the current phase 1 deal we just got. But we still pulled the profit. And so the big idea is that you can simplify your portfolio to have only 4 ETFs and become extremely diversified. And this portfolio is everything you need to protect your assets and generate return for all of retirement. Our goal is income and safety, not growth or speculation. This allows investors to simplify your holdings, reduce your risk, get better results with less work, and weather-proof your retirement portfolio. Now, most money managers, especially at the bigger institutions, they're instructed to be bullish at all times. The idea that stocks are going to go down is blasphemy. And because we've been in this 40-year business cycle from 1980 to current, most people believe them, but they don't realize that we're running out of rope. The central banks have only kept this up because Paul Volcker during the 70s, during the runaway inflation, he jacked up interest rates all the way to 20%. So because we've been able to cut rates from 20% for 30 years with Alan Greenspan and then carry on the torch with Bernanke and Janet, now Powell, we've been able to keep bubbling up the market a little bit higher. The catch is we're at 1.75% on the federal funds rate. And so their room to continue growing the bubble is coming to an end. And you're not going to want to be having your money managed by someone who thinks that the bull market will never end. And so that's what's so important about our trading plan. Also, it's a daily webinar, so you can join us back on Monday. Highly recommend it. You get to meet people who've bought the program as well as people interested in joining every single day. But what's important is we trade the same assets at the same time on a very consistent, easy to follow schedule, which means people actually get the exact results that we're providing, whether it's good or bad. And you'll see, sometimes we got to do our audit, which is a daily audit on all 4 positions. And I got to show you, hey, we're down. And I'll tell you why we're down and why we're continuing to play the trade in a certain way. So you get to see the good, the bad, the ugly. Although with our strategy, an ugly month for me is losing 0.1%. The worst month was, well, obviously the only losing month was 1% in July. Now the catch is you're not going to get rich with this program. That's not the kind of clientele we attract. And in fact, here's all you really need to know is that here's your trading plan. We alter it slightly depending on what's happening with the trade war currently. So if it's up in the air, like it is currently, we're long all our assets, but still protected with option callers. If the trade war escalates, we know exactly what happens. Stocks sell off for a short period of time. Bonds and gold rally higher. So you can see we have this all planned out. Everybody knows what to expect. And if the trade war de-escalates in a real fashion, we've seen that stocks go up and there's a short-term pullback in bonds and gold. And so we essentially have three different ways to play the market with options, which is the bullish loose option caller, the neutral tight option caller, which allows us to generate a profit if it goes flat. And then we have a bearish inverted option caller, which actually allows us to own the asset and take advantage of that by selling an in-the-money call option to buy an in-the-money put. And in this setup, we actually generate profit from that asset class traveling lower. So does that make sense? What questions do you have so far?
Well, like I say, it's all of this is a foreign language to me right now. So I've got to be, doing some studying on my own just to grasp what you're doing. But I mean, I get the gist of, how you're playing the market so that you consistently are trying to get about 12% a year.
Yeah, you might be a good candidate for our boot camp too. So this is actually a bonus for a month, right when you join. Now this is a program that it's a one-time purchase and you're in it for life, and the modules repeat twice a year. And you can access all the modules we've released so far. So far we've done the first 3 modules, and the 4th module is coming up not this Tuesday, but next. And that's where I'm going to really train you inside out on everything. Because you're right, there's no way, even in the 2 hours that I just presented today, I only got through 20 slides of the module 1 of our boot camp. And that first module has 94 slides. So module 1, big picture. Let's understand why this works, how it works. Module 2, we're going to figure out how to actually place the trade, so at least technically how to follow the program. You may not understand everything going on at this point, but you'll be able to accurately follow it, get in and out of the positions. Module 3, we start really deep diving into the option market. What does it mean to be short a call option and long a put? How do these play into the big picture? Now these modules are much more interactive, much more like a tennis lesson. Yeah, you could watch a pro tennis player serve it. That doesn't mean you're going to be able to serve the ball. So the next few modules are dedicated to really quizzing you with a lot of examples, trying to trick you, make sure we can pick up the gap in knowledge. And it just goes on and on. There's a whole lot of information.
So I do have a couple of questions. How much is that particular course?
So the retail price on the advisory is $5,000 a year, and the retail price on the boot camp is $10,000. We do have some packages where you can save money. We have a lifetime deal on the advisory where you pay a one-time fee, so you're not going to be paying this every year. Where we can sometimes also discount a lifetime package on the boot camp. If you got started today, we can discount your annual rate and give you a free month in the boot camp. So you can at least get a month of education and see if this is something you'd really want to invest your time in.
And how is it going to play out with Schwab buying Ameritrade?
Yeah, we love Ameritrade. I've got a lot of clients with 7 figures at Schwab. So it's great. I mean, that just means less expenses on our trading. I love Ameritrade's platform. The mobile app is what's so beautiful. Let's see, and I'll pull up.
Are they going to be
They have
able
2
to?
phone apps. I've got clients, Robert, who are trading 7 figures, multiple 7 figures from their phone app on the go. Literally, they're having a lunch with their niece and they're placing the trade on their phone with 7 figures. So yeah, it's a very passive strategy. It's super safe. Every trade is, you know, just by owning the SPY and TLT, it's a very safe strategy. That's what 99% of your big hedge funds do. But they're so large, they can't take advantage of the options market. So because we're, you know, for your average Joe, if you've managed to save $1 million, you know, many people think of you as rich, but in the markets we're trading, you know, we probably have around $50 million following us. If I had to guess, I don't know, but just from talking to clients, we don't even put a dent. We don't even put a micro scratch on the liquidity in these markets. So we can take up the safety element to a whole new level by adapting options on top of our stock bond strategy.
Okay.
Well, I need to look at this before I make any commitments to see if it's something I can do.
Yeah, of course. Well, here's what I recommend. Why don't you wait 10 minutes, go get yourself a nice drink and a little snack, and then click that link in the trade alert video. And I would say this is one of the better 2-hour presentations we did. And unfortunately, I really got to only the tip of the iceberg in how the strategy works. Module 1 is really, really cool. I think people, when they usually buy some sort of option trading boot camp, they expect a lot of technical information. But I'm more macro and fundamental. So you're going to learn, if you like to learn about
Which is what's
history.
actually important and valuable.
Yeah, it's much more valuable than any sort of technical tutorial. Most of the technical tutorials are all free out there. That's certainly how I learned the technical side. But really understanding the fundamentals and the history is really what sets great investors from lucky investors. So you could get lucky and follow momentum all day until you lose until you lose big when the market changes. But once you understand the big picture, which is this chart right here, and I take you back through 100 years of US history, and we're going to pay attention to what the Fed has done, why they've done it, and how that impacts markets. And so the bottom line is, once you understand this chart I have on the screen, you're going to get that money the hell out of UBS because you're going to realize what's coming. And what's coming is exactly, do you understand what this chart shows you right here?
Not really. Oh,
Okay,
well,
so
yeah.
this is the single most important chart that anyone who really knows what's going on in finance is terrified of. And so, you know, they say we're in the longest US business expansion in history, 11 years. I'd argue that we're really in a 40-year business cycle. And that's because the cost of money has gone from 20%, 1980, Paul Volcker, who passed away 2 days, he jacked those rates so high because of the inflation in the 70s, which was caused from massive social programs after World War II. Everybody felt bad. You know, lots of lives had been lost. Money had been wasted. People had lived through terrible conditions. We just got out of the Great Depression in 1930. So we wanted to spin. Sound like today? Sure does. But the bottom line is, the only reason we've been able to continue boosting the stock market higher and higher after each recession is the ability to reduce the cost of money at the federal fund rate. And the second they ever hike those rates up, you get a recession. So every time you see that blue line spike, what do you see? A gray bar. That's your stock market crash. Okay, so they've been able to pull this off for 40 years because they started from an extremely high point. The problem now is we're at 1.7. So borrowing money is essentially free. What happens next? Inflation and rates go higher. If rates go higher, here's what's going to happen to your stock market. And I'll just show you this chart and we'll probably call it a day. But this is what you really got to focus on. If you're going into retirement and you have some savings, this is going to be the death trap for your savings, is that you're going to think, and your advisor is going to tell you, don't worry, Robert, this recession will just be like the last few. We can buy and hold. We can do a little hedging. It's going to be okay. Remain long, stay invested in stocks. I guarantee you that's what he's going to tell you no matter what's happening. Now, look what happened from 1965 through 1980. Okay, we had a similar period where we had these little recessions that were rebounded. But guess what? Once they got to near zero interest rates, they couldn't pull that off anymore. And all the misallocation of capital from lots of social programs, good old FDR got us out of the Great Depression, but it came at a cost. And eventually we had a 15-year bear market. And during that whole period, interest rates were going up and inflation was going up. And in fact, if you had purchased stocks in 1965, you didn't get the value of your stocks back till 1990. So you lost money for 30 years while inflation was rocketing high. And so I can promise you that's one thing that we really stand out. We understand the big picture. We understand the course of history. And we understand that most likely outcome is not another 10, 20-year business cycle. Most likely outcome is that the exact opposite is about to repeat itself, just like it did after World War II, which is rising interest rates and trying to fight inflation from all the money that's been printed. And you better bet there's been a whole lot of money printed when interest rates are at zero. You're going to make a lot better business decision when it costs you 5, 10% to borrow money than when it costs you nothing. And so we've been living in a world.
Noon. You stay there all day?
Thanks to old Janet Yellen and Obama,
Come on out.
we've lived in a
Now he
0%
wants to show you his
rate from
airplane. He's coming in
2010
behind
to 2015,
He's doing
and
it
the
every
debt
time
has
he goes, he goes,
exploded.
I did it. I did it. Over and over. He's so proud.
Okay.
All right, Robert. Well, hey, let's let you rewatch today's presentation, and we'll follow up with you maybe later this evening or Monday. Okay.
Okay, thanks a lot.
Thank you.
Yep. And Robert, make sure to save my cell phone number too, bud, and call me if you have any questions while you're going through the video too. Okay.
Okay,
Cool. And it's 505-322-7515.
okay, thanks.
Thank you.
My pleasure, Robert. Thanks for coming in.
Bye-bye.
All right, guys. Any questions out there? Dawn, any questions? The couple random guest that I'm not sure who they are, but please feel free to ask any questions. If there's no questions, folks, we're going to go ahead and wrap this up. Once again, 505-322-7515. Call me if you have any additional questions or want to get started today.